Recording started.
Okay, good morning, everyone. We're going to finish chapter 5 today. Today we have a few homework exercises. They'll go pretty quickly. Today is a heavy question day, so we'll see a bunch of those. Before we go too far, just a reminder about what to do. We have an attendance quiz covering Monday and today. That will become available by 5 p.m. today, chapter 5 homework, and then video quiz over chapter 6 on Sunday. Okay, times to see your exams. These changed today, 9:30 to 11, and then the new time, Thursday, tomorrow, from 11:30 a.m. to 12:30 p.m. So those are two times, room 579. If you absolutely cannot make those times, I need to hear from you. We generally don't extend exam viewing on for weeks and weeks because it really only makes sense close soon after you take it, so it's still fresh in your mind. Our exams in here are not cumulative, so you're not going to see those same questions. That said, if you didn't get a very, very high score, it's always good to see what you did wrong because that'll help you in terms of how you prepare for the next exam. So I would urge you to come see your exam with Brian, or let me know. We will have a couple appointments next week, but we need to know soon. Okay. The final is not cumulative either. Okay. So once you've seen your exam, come see me and we can talk about it because I've had some people email me they want to talk about their exam. So see your exam first. I have office hours after this class. What? And so I have office hours at 9:30 to 11 and 1 to 2. And I'm in room 572 in the College of Business. You find the elevator, which is in between. I had somebody the other day email me and couldn't find the 5th floor. So to get to the 5th floor, the easiest way is elevator. Elevator is on the 1st floor by the undergrad advising office on either side. So you just take it to the 5th floor and then room 572. The building, by the way, on the 5th floor is like a figure 8, so you head one way, and if you don't see the right numbers, just keep walking around. It is all connected. Okay. Okay, questions before we get started? Questions about anything? Okay. Okay, reminder plug. So far I think I'm up to 69 people have come to see me. I was hoping to get at least to 200. So please come see me. If my scheduled office hours don't work for you, we can do this right before class someday. As long as I have the equipment set up and I'm wandering around, we can do it then, as long as it's not right before class starts. Or we can do it right after class ends most days. So I would like to meet you. I would like to take your picture. And so do know that you get to earn a do-over at any point in the semester up to December 2nd. You can return to me and let me know what you want to do over, and I can open it up for a week. But you've got till October 23rd, which is roughly right before our second exam. This is just so everyone doesn't come see me finals week. Okay, so. Okay, so let's start with the questions. So now we're into material. So the first question is allowance for uncollectible accounts. Okay, so that's an account. What kind of account is it? A contra expense account, a contra revenue account, a contra asset account, or none of the above? I'm going to pause for a minute while I see people writing down the question. So you get this question. So what do you think? B, contra revenue? Okay. What about you? I don't know. Allowance for uncollectible accounts? Okay. C? Okay. Okay. Do you have answers online? Yeah. Right now, okay, right now I'm running 33% A, 33% B, 33% C. So let's see. What are you? B. Oh, sorry, C. I'm now scaring people as I walk up behind them. Okay. Okay, so the answer is going to be C. Was this one time, Brian, that your people got better percentage than me? Okay, yes, okay. So, okay, let's go to another one then. Okay, now we're down to 50-50 rules, 50-50 odds. There are two basic ways to estimate uncollectibles, the direct write-off method and the allowance method. So this would have been in the video lectures in the chapter. True? Okay. True. Okay. What do you think? What do you think? Can you say it a little louder? It's really loud. False. False. Yay! Well, I found a false. Yay, good for you. Yeah, yeah. Good job. Yeah. I have 5. Okay, how many truths? A bunch? What? Yeah. It's a pointer. No. Oh, well, I guess I can move it. That was rather random. Okay, so this is false. Good job. I'm coming back to you next. Okay, but no, this is, and this is one of the a little confusing items. So that's why we put the question up. Is there are actually two ways to estimate collectibles. We have the percentage of sales method, and we have the aging schedule method. Now, the direct write-off method deals with something else, and we'll talk about that again in a minute. We talked a little bit about it Monday. So direct write-off is something, but it's not a way to estimate uncollectibles. When we talk about estimating uncollectibles, we're talking about saying, here's our sales for the period. Which ones of these things, sales in accounts receivable, are not going to pay us back? And we have to estimate that. Remember, we don't know who's not going to pay us back, or we wouldn't sell to them in the first place. So this is estimated. So we have two ways to do that. We can do the percentage of sales method, or we can do the aging schedule method, aging of accounts receivable method. And the direct write-off method, we'll see that a little bit later today. So we'll see what that is. That's very different from estimating our uncollectibles. Okay, so following up on that then, there are two methods to estimate receivables. The first method, percentage of sales, how we do that is we just say, this is the easy method. We take our sales for the period times the percentage, and then that's what our uncollectible expense is. That's referred to as the income statement method. And I'm going to pause while you write, and so I'll start talking when I see the pencils go down. Come back to that. Okay, so percentage of sales, take a percentage of sales each period. That's known as the income statement method because we're focusing it on the sales, which sales is an income statement account. Now the other method is an aging schedule, and this is what when we calculate what the balance should be, which is, so we're saying allowance is a balance sheet account. Allowance is a contra asset. What allowance does is when we estimate how much of our accounts receivable is uncollectible, the allowance is a contra asset. So it reduces what we think we're going to be able to collect. So if customers owe us $100,000 and we estimate that $10,000 of that is uncollectible, then the allowance count is going to be on the balance sheet. It's going to actually reduce receivables. So we'll have the $100,000 that we're owed. We'll subtract our allowance of 10, giving us net of 90. So we're saying to the world that we expect to collect 90,000. We don't want to leave the accounts receivable on our books for 100,000 if there's not a good realistic chance we're going to collect the whole 100,000. So allowance, the aging schedule is known as the balance sheet method because it's focused on the balance in the allowance account. So we're going to do both of these today. It's also called the percentage of receivables method. Okay, so what we're going to do here is we are going to do exercise 5-12. We have accounts receivable balance of $26,000. I'm looking at the problem now, and allowance for uncollectible accounts of $2,000. Okay, so there's our contra asset. And the 2012 service revenues on account totaled $183,000. Cash collections on account totaled $133,000. And then they wrote off uncollectible accounts receivable. So they've got a lot of things going on there. And it says on December 31st, 2012, the aging of accounts receivable, meaning this aging schedule, indicated that they would not collect $1,790. So they've gone through and they've said, we will not be able to collect $1,790. That's our best estimate. We don't know that for sure, but that's our best estimate. So it's asking us for journal entries. So we have journal entry A, B, C, and D. So we have 4 journal entries. Some of them are very similar to what we did on Monday. The first one is to journalize their service revenue. Now their service revenue, it tells us about the second line down, the 2012 service revenues on account totaled $183,000. So what we're going to do there, okay, we're going to that $183,000 second sentence. I guess I didn't circle it, but $183,000 accounts receivable debit, credit sales revenue. Whenever we record revenue on account, we are going to debit accounts receivable. We're increasing that asset. These people owe us money, and we're going to credit sales revenue because our sales are increasing. So that's a very, very standard journal entry for recognizing revenue on account. We made sales on account. So you're going to see that journal entry over and over and over. That's what it's going to look like. Okay, the next entry is not a bad entry either. Collections on accounts. This is just saying, let's in one journal entry recognize all the cash we collected on account this year. So that cash collection on account, we're going to debit cash because we're getting cash in, and we're going to credit accounts receivable because they're paying it back. And that's about the third line down. It tells us cash collections on account totaled $133,000. Okay, so that's a very standard entry. We're going to debit cash because we're getting cash. We're going to credit accounts receivable because people are paying off their accounts. So what they've done here is instead of recording every single transaction, they're just, for the sake of illustration here, lumping it all together for us. Okay, so I'm going to be talking about direct write-off method coming up, so just hold on direct write-off. Oh, I couldn't see. Okay, so then next, C, write-off of uncollectible receivable. Okay, so here is write-off. This is where we've determined that some of these accounts are uncollectible. Okay, so that sentence that's 1, 2, 3, third line down where it says, during 2012, Gulig and Daugherty wrote off uncollectible accounts receivable of $2,500. Okay, that write-off of accounts receivable, what they're doing there is they are determining that these specific accounts they are not going to collect. These places went belly up. We assume that when they did their estimating journal entry that these are the ones that they were estimating for, but a direct write-off, the only thing a direct write-off does is it pulls it out of accounts receivable and it pulls it out of the allowance account. So when you see they wrote off, it should trigger a journal entry that looks like this. We will debit allowance for uncollectible accounts. We're pulling it out of allowance accounts. We are going to credit accounts receivable to pull it out of accounts receivable. So when you see the word write off, that means they've identified these specific accounts and they are going to remove it from allowance account, remove it from accounts receivable. This is the journal entry. So you see write-off, here's the journal entry. Notice that there is no income statement impact of a write-off. All we're doing is we're taking it off our balance sheet. We're taking it out of the accounts receivable. We're taking it out of the allowance. Net accounts receivable will remain exactly the same. So when we say that the direct write-off method is not a method of estimating, that's true, because estimating says, oh, we think these accounts, we think this amount of accounts not going to be able to pay us, but we don't know which ones. Direct write-off, these places have gone belly up, or for some reason it's evident that these customers are indeed the deadbeats that we were estimating for, that we didn't know. So now we want to say, let's take them out of accounts receivable, because why have them keep staying in my list of accounts receivable? So I'm going to take them out of accounts receivable. I'm going to take them out of the allowance account, saying, well, there's no need for me to estimate for this anymore. I've identified it. Let me just pull it out of both places. So when you have a direct write-off, there is no income statement impact. A direct write-off, you're always going to see this journal entry that's in C. That's how it works. Okay, so now we get to D, and D is the most challenging exercise journal in this exercise. Okay, so what the strategy I want to do with D is I'm going to I'm putting out there, I'm going to let you write it down, and then I'm going to show you where it all comes from. So this is a write it down on faith thing, and then we're going to explain where everything comes from. So I'm going to pause for a minute. Okay, some things I want to point out before I leave this screen. I've highlighted in yellow at the top where it says an allowance for uncollectible accounts of $2,000. That's what they started the year with in that allowance account. So on their balance sheet, they think they have uncollectible accounts. Their best estimate was $2,000 at the beginning of the year. I highlighted down quite a ways that at December 31st, they determined that they will not collect 1,790 of the accounts receivable. So we have the first highlight is the beginning balance of accounts allowance account. The second highlight is the ending balance. So that's what we have. So now we're going to walk through how we get this journal entry. Okay? So the 2,290, we're going to go through that. So, okay, what you see in A, B, C, D are those 4 journal entries we just went through. So you've got those written down. Now what I've done is I've drawn the T account for the allowance for uncollectible accounts. The T account for allowance for uncollectible accounts, it will have a normal credit balance because this is a contra asset. Contra asset means that it is opposite of a regular asset. It's offsetting accounts receivable, so it's going to reduce our accounts receivable. Okay? Now, what I've done in my T account is I've put in my beginning balance from that first highlight we saw, and I put in my ending balance from that second highlight. So this is looking at the problem itself. Okay, so that 2,000 and the 1,790, just to be clear on that, the 2,000 was our beginning balance, that first highlight. 1,790 was that second highlight. Okay? So next what I do is the write-off. I had write-offs. I had a journal entry here, allowance for uncollectible accounts where I debited it. Okay? So remember, we're working on the entry for D right now. So we're going to look over entry A, B, and C for anything that impacted the allowance for uncollectible accounts. And we see that we had a debit to it in C. So that's where that 2,500 is. Okay? So all we've done right now is reconstruct the information that they gave us in the problem. Now there's no other entries on allowance for uncollectible accounts. It will not balance right now. If I took $2,000, subtracted 2,500, it's not going to give me 1,790. It'll give me a debit balance of 500, and that's not what I want. What I'm looking for is what entry I need to make this account balance. So where we go now is my uncollectible account expense. I have to solve for it. And how I'm going to solve for that, it's actually 2,290 is down there at the bottom. I'll take the 2,000 plus something minus 2,500 gives me the 1,790. So I'm just flipping it around to solve for X, and the X is 2,290. And I have no idea what's after the word uncollectible. It's just a random character that I have no idea. That must have been something with the font carry over again. So again, the part that I've highlighted, the name of the account is uncollectible account expense. I don't know what that O and the E squished together, or maybe it's just sometimes fonts do weird things when you import them. Okay. So that's how we get the amount of the uncollectible account expense. Something to note about this. This entry that we just did is one of the more challenging entries because it doesn't necessarily need to be in the order it is. I would say most of the time you're going to debit uncollectible account expense and you're going to credit allowance. It is possible to do the opposite, not probable, but that's how you would do entry D. Questions before we go on? Okay, so some more questions. I think I have several in a row here. Under the allowance method, the entry to write off a $2,600 uncollectible account includes A. Okay, so what I would do here is ignore the answers and think about the entry you would make to write off an uncollectible account. And not only just think about it, but look it up in your notes and think and see what you would do. Okay, I'm going to start here because I'm here. What's your entry? So ignoring answers here. So what are you going to do when you write off an account? Okay. Can you repeat that? Wait.
Yes. I did allowance for uncollectible account, and I did it for $2,600.
Uh-huh.
And then I did accounts receivable and a credit of $2,600.
That is absolutely correct. So on this, so your answer on this is going to be yeah. So we have your debit for allowance, credit, accounts receivable. That's our entry. Okay, so this reminder, so what's important on this one is the word write-off. The word write-off should trigger that debit to allowance for uncollectible accounts and credit accounts receivable. Okay, next question. Now this one shouldn't be bad. We said it once today already. So the net realizable value of accounts receivable is the difference between accounts receivable and what? A, sales discount, B, allowance for uncollectible accounts, C, uncollectible account expense, or D, net revenue. Okay, I'm over here. What do you think? B? Okay, what do you think? D? Okay. What do you think? B? Okay. C? Okay. What do you guys think? B? D? Okay, so we've got some B's and D's. How are you doing online? He'd rather not say. Okay, so I see that I'm gaining again. Okay, so the net realizable value of accounts receivable is the difference between accounts receivable and the allowance for uncollectible accounts. That allowance for uncollectible accounts is a contra asset. So when we talk about net realizable value, that's a very specific term. Okay, you see a lot of times on financial statements they'll talk about the net realizable value. That's saying what's the company's best estimate of how much of their accounts receivable they're going to actually collect. So you're taking their accounts receivable, you're subtracting their allowance account. Okay, so I'm going to hit all of these. I'll go through all of them. Good idea. Okay, so let's talk about the answers it's not and why. First of all, it's not sales discounts. Sales discounts will reduce sales revenue, so that belongs on the income statement. Allowance, actually the only answer here on any of these that's related to the balance sheet is B. The allowance account is a contra asset. That allowance for uncollectible accounts always gets shown with the asset. Now the next one one down, uncollectible account expense, that is an expense. That's how much uncollectible account expense we're estimating this year, and that belongs on the income statement. Okay? It can be different from the balance of the allowance. The uncollectible account expense is how much expense is for this year. But we can have an allowance account on the balance sheet that includes allowance for prior year sales, because we might have accounts from a year or two ago that haven't paid us yet. So we've got allowance on the balance sheet relates to all of our uncollectibles. This uncollectible account expense only relates to our estimate for this year, so it belongs on the income statement. And net revenue doesn't have anything to do with accounts receivable either. Okay, so I'm going to go on. Okay, I emailed this out yesterday, just a reminder. I didn't want to cram-pack things into class, so if you need help with this exercise, I did walk through it, and I did email that out, and it's an announcement on Blackboard as well. So you can watch that if you need it when you're doing that homework exercise, S5-14. More questions. I told you it's a lot of questions today. A company reports accounts receivable on the balance sheet at a net realizable value of $586,592. So net realizable value, as soon as I see the word net realizable value, I know that's accounts receivable minus the allowance. So it's telling me the net realizable value. If it's gross receivables were $612,854, then the balance in the allowance account has to be what? Who's just saying hi? Okay, I just had a question, which is a good point. Gross receivables, all that's saying is that's accounts receivable. Okay, so gross is just telling you that's not net. That's just accounts receivable. So the accounts receivable balance is $612,854. Okay. Okay, I'm going to do a sample of one. You're it. What answer? Oh, okay, that's okay. Well, I'm going to change my sample of one. I'm going to go over here. What are you going to tell me? You're going to tell me it's
A.
A. I have 100% A. Brian has 85%. You did that in your head? Okay. So the answer is A. What we're going to do there is accounts receivable minus the allowance is net realizable value. So I can turn that around. It's giving me the bottom number. It's giving me net realizable value. It's giving me the top number, accounts receivable, so that I can solve for what the allowance has to be. Again, that word gross, all that's telling you is this is accounts receivable. Okay? So the word gross isn't an accounting term per se. It's just saying that this is before we've reduced accounts receivable for anything. I won. Okay, we're good there. Okay, so let's go on. Oh, a new term. We haven't talked about this in class. When goods are shipped FOB destination, revenue is recognized by the seller when the goods leave the seller's shipping dock. True or false? Yes or no? Okay, so I have a false here. I'm going to go back and collect some other observations here. So what do you think? True? You what?
I do not.
You don't know. Okay. Okay. You were thinking false. Okay. Okay. You think it's true. Okay. True. Okay. What about you? False. True. False. 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 Oh, true. No, I don't want to go back to you. What did you say? We said false. Okay. Now, let's talk about why it's false. You're absolutely right on the false. Let's talk about it. And this, I will admit, I have to think about every single time. And I'll tell you how I reason my way through. There's two shipping terms, right, that we have. We have FOB destination and FOB shipping point. And I have to say this slowly because I'm likely to say it backwards. I always write it down, make sure it's written down right, and then I can answer anything off of that. This is just one that I think is hard and confusing to remember. So it's definitely something that I would put on my reference sheet to have by my side. Okay, FOB destination. So we ask ourselves, the FOB stands for free on board. Okay, so we say, whoa, destination, where is destination? We have the seller and we have the buyer, right? Destination is at the buyer. So FOB destination means that the seller owns it until it gets to the buyer, okay? So in this case, this is false because the seller hasn't actually sold it until it reaches the destination, okay? So this is false. FOB destination means that title does not transfer until it reaches its destination, which means we haven't, as the seller, we have technically not sold that until it reaches its destination. Okay, so I think we have another one here of these. Great. Okay, so another one, just to test on this one. ABC Company has shipped goods to one of its customers using FOB shipping point. ABC Company will recognize sales revenue when what? What do you think? Yeah? B? You're going to go with B, right? Okay. Okay. I've got 100% B, Brian. If you could see online how he's looking at me, he obviously doesn't have 100% B. Okay. The answer is B. FOB shipping point means that title transfers right when we ship it. So when it leaves our dock, that title has transferred. So that's when we recognize sales revenue when title transfers, when we've delivered it, and it's considered delivered at the point of title transfer. So those are FOB destination and FOB shipping point are not too bad. Let's write them down. Yes. Wait, hold on.
So revenue, when the seller gets it, I'm guessing, I'm trying to figure out what the difference between the first question we did and
Okay, so you want the difference between the two questions. Okay, so this question, we had FOB shipping point, which meant it transferred at the point of shipping, so that when we're shipping it off our dock, it transfers. So we're going to recognize right when we ship. Okay, this is this one right here. So then let me just flip back to this one, okay? This one was FOB destination, which means it doesn't transfer until it reaches its destination. So they still own it until it reaches its destination.
Okay.
Okay?
Thank you.
Okay. Okay, another question. Heavy question day. A business offers credit terms of 115 net 30. What do these terms indicate? So I'll give you a minute to write it down and select your answer, and I'm going to go around and poll. Okay, what do you think? B. B. Okay. Okay. B? B. I guess. Okay. B? No, what are you going to say? B? Kind of?
Yeah.
Well, you have a lot of companies, B. B? Do you have 100% B? Okay, and the answer is absolutely B. So that, what?
I had a lot of these.
You got a lot of B's. Okay. Okay. So 115, that says that the customer can take a 1% discount if the customer pays within 15 days. Otherwise, the whole invoice is due within 30 days. If you think about it, these are pretty generous terms. If you got 1% discount for 15 days, that's a large interest rate over the course of a year if you got a 1% discount for every 15 days. So these terms are quite lucrative for companies to take advantage of. Even though you look at it and you go, oh, it's only 1% or 2%, it's a lot, especially considering today's interest rates. Okay, another term we did not talk about in physical class here yet. A separate account for each customer is kept where? In a control account, a subsidiary ledger, a general ledger, or a control ledger. Say B. Okay, so we have a B. Anybody else agree with her? We have an agreement over here. See a lot of hands going up. I've got all B's, Brian. Okay, mostly. Okay, so we do want to say a subsidiary ledger is really important to talk about. A subsidiary ledger, let's say, so we have accounts receivable, right? It's an account on the balance sheet, and what it does is it holds a running total of everything that our customers owe us. So when we make a sale to a customer, it goes into accounts receivable. When a customer pays us, it comes out of accounts receivable. So at any given time, we look at accounts receivable. That's a list of what everything customers owe us, less what they paid us, of course. And let's ignore the uncollectible, the allowance account for now, okay? Because that's our estimate of, in general, what amount we're not going to collect. But so we have this accounts receivable on the balance sheet. We can't just have numbers made up. We have to have some control over our balance sheet. So this accounts receivable, it seems reasonable as a business owner. If I have an account that's accounts receivable that says this is what my customers owe me, I want to know which customers those are, right? Because I want to be able to collect money from those customers. We don't just put it in there and forget about it and hope they pay us. As business owners or business managers, we have to collect accounts. We have to send statements out. We sometimes have to do collection activities. But we need to keep control over who owes us what. We need to know that. We also need to prove to our external auditors that that asset that we're listing is really true, that we're just not making up numbers. If we weren't able to substantiate accounts receivable, so if there was no proof of what accounts receivable was, companies could just make up sales. They could say, oh, today I sold $200,000. What am I going to do? I'll debit accounts receivable, credit sales revenue. My income statement's going to look wonderful. Well, but there's nothing to back it up because auditors are going to come in and say, let's look at your accounts receivable. Now, auditors aren't just going to say, let me look at the balance in the general ledger account, because there's thousands and thousands and millions of transactions that can go through there. So what we have instead is we have something called a subsidiary ledger. And what it is, it's a listing of all our individual customers and how much they owe us. And if we go into each customer's account, we look up their account, it'll tell us this customer owes us $1,000, this one owes us $2,000. So we have this ongoing list. If we add up all those customers' accounts, they will total the accounts receivable total. And all those individual customer accounts, that's called the subsidiary ledger. It provides detail of what's going on in the general ledger in a specific account. So we can have a subsidiary ledger for different accounts, but we have one for accounts receivable that says, gee, here's all the individual accounts receivable that add up to be the big accounts receivable balance on the balance sheet, okay? And it's just each individual account is part of that subsidiary ledger. So subsidiary ledger gives us proof of our accounts receivable. It also gives us information as managers who owes us money, who we need to collect from, okay? Just as an aside, we can have a subsidiary ledger for, this is for accounts receivable. We can also have one for accounts payable. Doesn't it make sense that as a manager, I want to know who I owe? I just don't want to know I owe $50,000 in total. I want to know how much I owe each vendor. So we can have subsidiary ledgers for accounts payable. We can have subsidiary accounts for several different balance sheet items. But right now we're talking about subsidiary account for accounts receivable. Okay, now moving on. Not only can we have accounts receivable, but we can have notes receivable. Notes receivable are when we loan money and someone's going to pay us back. Typically, banks have notes receivable. A note receivable usually carries interest on it, and it's called a note receivable because there's a legal document called a promissory note. And this note is signed, and it's legally binding that you have to pay, that someone has to pay the money. So we're going to do this exercise. This is about a note receivable. So the bank lent $150,000 to Sherman Summers on a 3-month, 8% note. Record the following for the bank. So we are doing this from the bank standpoint. So the first one, lending the money on February 10th. So this is where the bank hands over the cash and now has a note receivable. So what we're going to see on February 10th there, loaning the money, we are going to debit, note receivable, and credit cash. And we just put the name of the person in there. That's just a note for you to, I want to say note. It's a memo for you to know that that's why that's going into notes receivable. Summers owes the note receivable. Okay, so we are doing this from the bank standpoint. So the bank now has an asset called note receivable, and the bank gave out cash of $150,000. So note receivable, this is a 3-month note, so it's a short-term or a current asset. Okay, next entry down then. Collecting the principal and interest at maturity. Okay, so we're going to collect principal and interest at maturity, specify the date. This is a 3-month note. So a 3-month note is going to be on May 10th. I'm going to let you write this down, then I'll talk it through. So I'll be quiet for a moment. Okay, so what's going on here in this entry on May 10th? First of all, how I do this entry is I skip around. I don't do the first number first. First thing I do is I'm skipping to that second line. I know that when they pay off the note, well, it's a 3-month note, so I add 3 months on to February 10th to get May 10th. Okay, so I'm going to credit my note receivable. I said I'm going to do it first. That doesn't mean I list it first. Remember, debits are always first and then credits. So my note receivable, when my customer pays off the note, I'm no longer going to have that asset. So I need to credit the asset for the original amount. So I am the bank when I'm talking I. So I loaned, back on February 10th, I loaned $150,000 note receivable. So I'm going to credit note receivable. Now, also then, I also got interest on that day. And the way I calculate interest on that day is by taking the amount of the note, the principal on the note, the $150,000, times 8%, times 3 months divided by 12. If this is a monthly note, we can just use number of months. So we're going to do 3 months out of 12. If it were a daily note, we would do the number of months, number of days out of 360. Or we're not going to have daily notes. I can't imagine that we'll have those. So we're going to do with months. We won't have to deal with partial months. Remember that if we do have it, you don't count the date the note is made. Okay, so the interest revenue on this note is $3,000, the $150,000 times 8% times 3/12. So then the total amount of cash I'm receiving as the bank is $150,000 plus $3,000 or $153,000. So those are just real basic transactions having to do with a note from the bank standpoint. Okay, true, false. A creditor has a note payable, true or false? Okay, I have a false here, so I'm going with my sample of 1. Yeah. Okay, so on this one, the borrower has a note payable, okay? The borrower does. This was asking the creditor. The creditor has a note receivable. So you have to watch really carefully which side you're talking about. A creditor is the one who loans the money, so that's going to be a note receivable. The borrower has the payable. Okay. Okay. Now, exercise 516, part 1. We're supposed to compute the amount of interest during 2012, 2013, and 2014 for the following note receivable. On May 31st, 2012, the bank lent $220,000 to Bob on a 2-year 8% note. Okay, so our note is a 2-year 8% note. It is May 31st, 2012. Those are all very important. And I put up there in red, interest equals principal times interest rate times the months divided by 12. And that's the formula we're going to be using. So we're still on part 1. I'm going to use the rest of the screen space. So I'm going to wait till I see pen stop, and then I'll start doing these. Okay, so for 2012, if we think about this, for 2012, the only confusing part of this is how many months we have it outstanding. So it doesn't hurt to count on your fingers, if I dare say that. We had June, July, August, September, October, November, December. I believe that is 7 months. Okay, so for 2012, we're going to have $220,000 principal times the 8% interest rate times 7 months out of 12. So that's June through December is 7 months. So we will have $10,267. I believe we're rounding that to the nearest whole dollar. Okay, then this note is a 2-year note. So we held it for 7 months in 2012. For 2013, it's the entire year. So the calculation is actually pretty easy, just $220,000 times 8%. We could multiply it by 12 divided by 12, but it is 1, so it's $17,600 for the entire year. And then for 2014, and again, we have to figure out how many months in 2014. This is going to mature on May 31st, 2014, so we will have January, February, March, April, May, 5 months. So we'll have $220,000 times 8% times 5 divided by 12. So we'll have $7,333 of interest in 2014. And again, we've got a full 24 months of interest there. We've got 7 months in 2012, 12 in 2013, and then the remaining 5 in 2014. That's the biggest thing on these, is counting up the number of months, and it's easy to get confused by one month or another. Okay, now, so that was the interest for calculation for part 1. So now we're going to move on to part 2. Part 2 says which party has a note receivable, which one has a note payable, which one has interest revenue, and which one has interest expense. And the two parties to this are the bank and Bob. Okay? So who has note receivable? The bank. Yes. So the bank has a note receivable. Who has a note payable? Bob. Okay. Who has interest revenue? The bank. And then interest expense? Bob. Okay? So you just have to keep track of who's who, because the accounting for this will be mirrored on either side. So we are going to get to a chapter later on when we'll deal with notes payable, and the accounting will be the same except on the other side, from the other side. Okay, now question 3 now says, how much in total would the bank collect if Bob paid the note off early, say on November 30th, 2012? Okay, so he borrowed the money on May 31st, 2012. He's paying it off early that same year, November 30th. So again, this is one where you need to count the number of months. You're going to have June, July, August, September, October, November. I think that's 6 months if I counted correctly, which we'll get to in a minute. So it's asking us in total how much they would collect. So we're going to have principal, okay, the amount of the note. So when we pay off a note, when we get a note that's paid off, the borrower is going to pay us the principal, and then the interest for the amount that it's held. So $220,000 times the 8% times the 6 months. And the 6 months is because we're doing June through November. That's 6 months. The day we borrow the note doesn't count. So then we have $8,800. So the total amount that the bank would collect if Bob paid this off on November 30th would be $228,800. Okay, we're going to do a couple questions now. Okay, true, false. The maturity value of a note is the sum of the principal less interest due at maturity. True or false? True or false? No pressure. False. He said false. No. No. Okay. Maturity value is going to, this is false. It's the principal plus the interest due. It's, so that will be our maturity value. Maturity value is the principal plus the amount of interest that they have. Okay, now the next question I have. You know what? I have two questions that are really lengthy to write down, and I just think that I'm going, you know what, I'll post an announcement with the next two questions. How would that be? Rather than you having to write them down. Okay, so what we're going to do now is we're going to skip those two. Okay, come on. Oops. Okay, so what's due, that was nice. Okay. Okay, so reminder about what's due. We have an attendance quiz over the 7th and the 9th. Now, there are two questions on the attendance quiz that potentially on the attendance quiz that we did not cover. I'm going to post those as an announcement this afternoon. So if you're looking for those, they're fairly lengthy. So I'll do a little explanation on there. So attendance quiz, Chapter 5 homework, and then video quiz 13. So that's it for class. Have a nice weekend, and I'll see you soon.